A mix of good news tonight and bad from Canada's budget watchdog. The last federal budget pegged the federal deficit at $52.8 billion. The latest report from Yves Giroux slashes that to less than half what the government is projecting next year at $25 billion. The catch? He's also warning of a severe global slowdown that will affect Canada. Yves Giroux is the Parliamentary Budget Officer. Hi, Mr. Giroux. Nice to see you again.
Likewise.
Thank you very much for coming in. We all feel it, and we know, Canadians know, that interest rates are rising. What is your assessment of that on the economy, the impact of that on the economy?
So we're expecting the increase in interest rates to have a negative impact on the economy, so to have the intended effect of slowing down the economy and dampening demand. And we are expecting to see numbers that show just that when they come out for the second half of 2022. So that's why we say we are expecting the second half of 2022 to show a slowdown, because we don't have yet the full set of numbers. And that slowdown in the economy to continue throughout next year, throughout most of next year. And then as the economic impacts of interest rates that are going up starts to fade, to see a pickup in the economic growth in 2024 and afterwards.
Do you expect economic growth to slow, or do you expect the economy to contract? And by that I mean, do you think that rising interest rates will trigger a recession at some point?
Barring any unforeseen economic shock on the world stage, for example, or central banks around the world to overshoot in increasing interest rates more than what we expect to be necessary, we don't see an economic contraction. So we anticipate an economic slowdown, so still economic growth, albeit at a slower pace, but no outright recession.
And is that because you see interest rates kind of topping out, or the key lending rate topping out around 4%? Is that accurate?
Yes, that's what we anticipate the Bank of Canada to do, increasing its interest rate to about 4% by the end of this year, could be early in the next year, maintain the rate at about that level for most of 2023, and to start decreasing its interest rates at the end of next year, and then further decreases as supply constraints ease and as demand is returning to more normal levels, so reducing inflationary pressures on the Canadian economy.
You mentioned some of the risks, but I'm wondering from your perspective what the greatest risks to the outlook you're providing now are. And by that I mean, what might lead to a recession? Because there are a lot of private forecasters right now in Canada, a lot of the big banks saying that they do expect a recession in this country.
So one of the biggest risks is overshoot by central banks, because they have been under tremendous pressure to tame inflation. So they might feel the need to do more. And it's very difficult, putting myself in their shoes, it's very difficult to determine exactly when you've done enough without pushing economies into a recession. So that's one of the risks, that central banks unwillingly or by accident overshooting, introducing more fiscal restraint than necessary and forcing advanced economies into a recession, be it the Bank of Canada or the Fed. So that is a big risk, especially with high levels of debt for households and the impact this would have on housing, and notably the housing sector.
So for those Canadians who are worried about the possibility of a recession, you're saying keep our eye on the Bank of Canada. You know, that's really the thing to watch.
It's one of the main things to watch. The other thing, which is difficult to ascertain, is an economic shock elsewhere in the world. For example, if something even worse happens in Ukraine, or if there's an economic shock or an emerging economy that goes into default with the imbalances we are seeing, like the strength of the US dollar, that could trigger a fiscal or a financial crisis in some emerging economies. But it's difficult to keep an eye on virtually like dozens of countries around the world. That's why central banks is much easier to focus on, and that's where one of the main risks lie.
What does all this mean for the government, the federal government's bottom line?
Well, it means good news, surprisingly, for the Canadian government, in the sense that inflation has increased the tax revenues that the government collects. So we estimate that over a 6-year period, the increase in inflation compared to our own March outlook has increased federal government revenues by about $83 million over that 6-year period. So it's relatively good news for the Canadian government. In fact, we anticipate lower deficits than forecasted a couple of months ago because of that higher inflation, with the deficit in the current fiscal year about $26 billion, and it could go down in the absence of an economic shock or significant new spending initiatives. The deficit could reach about $3 billion in 2026-27, which is virtually a balanced budget by then. But again, it would mean that, or it would imply that the government does not embark on new spending measures or tax cuts,
right.
Which
two big question marks at this point.
Exactly. It's in somebody else's mind or somebody else to decide.
What about the effect of these increasing interest rates on servicing the debt that the government holds right now?
Well, that's the flip side of increasing interest rates. It lowers inflation, but it means that the government costs for servicing that debt, so paying interest on the debt, goes up. So we estimate that it will more than double over a 5 or 6 year horizon, going from about $20 billion last year and rising to about $46 billion by 2026. So a significant increase because of the increase in interest rates and the increase in the size of the debt itself.
Okay, 2 quick reality check questions for you based on the political debate that's going on right now. Is government spending right now inflationary?
It's hard to say it's inflationary compared to pandemic spending, where the government opened literally like the coffers and spent massively. But if you compare to pre-pandemic, maybe slightly inflationary, but compared certainly to 2020, it's not.
Would cutting payroll taxes, the increase in payroll taxes, as the Conservatives are proposing, or reversing this year's hike in the carbon tax or the price on carbon, would it decrease inflation? Would it be deflationary?
Well, it's a tough question to answer precisely. It would certainly relieve pressure on the employer side. Whether that would be passed on to shareholders or workers through higher dividends or higher wages is a big question mark. So if that got passed on entirely to consumers or to rather employees, then it could be slightly inflationary because it would put more money in workers' pockets. But again, it depends on the magnitude and the timing of that. So not a clear-cut answer.
Got it. That's okay. It's helpful anyway. Thank you very much, Mr. Giroux. Appreciate your time.
My pleasure.
Hi, I'm Vashi Capellos, host of Power in Politics. See more of our show by subscribing to the CBC News channel or click the link for another video.